When doing research to determine what cryptocurrency to invest in, it's easy to make the mistake of only relying on hype, news, headlines, blogs, websites, or even YouTube videos to guide your investment strategies. And although this is an important research step, looking at historical price movements of a coin, or technical analysis as it's called, is equally important. Learning how to read crypto charts is a great skill to have if you want to start buying and selling cryptocurrency. But you don't have to be a super expert analyst or trader to benefit from reading charts in order to make better educated investment decisions. And today we're going to go through a beginner's guide on how to read crypto charts so you can start making money with cryptocurrency. So let's get going.
We must proceed with caution.
I'm assuming if you clicked on this video, you want to learn more about what all of these colorful shapes, lines, and numbers mean. And having a basic understanding of what all this means, looking at charts and some chart patterns, will start you in the right direction. So let's take a look at the most simple chart, and that is a line chart. I use a program called TradingView, but if you have an account with an exchange like Binance, Kraken, or KuCoin, they have TradingView built into their advanced trading tools, and you have access for free. And I will leave links down in the description below for the different programs. All right, I'm in TradingView, and in the upper left-hand corner here, you will see the coin you are reviewing. So in this case, I'm looking at Bitcoin against USD, which is the US dollar coin, which tracks against the US dollar 1-for-1. So when you hear Bitcoin price, let's say its current price at $46,000, it's in US dollars. So on the bottom of this chart, you will see a time frame. So right here is June 1st, June 14th, June 22nd, and then July. And on the right hand side, you will see the price of the coin. And in this case, again, it's Bitcoin. You might see this access the price over on the left hand side, but it really depends on how you have it set up. Line charts are fine if you want to see the historical price and trend of a cryptocurrency, but most investors use what's known as a candlestick chart. So let's change our chart to a candlestick chart. So all I have to do is go right here, change it to candles, and that is a candlestick chart. Before we continue, let's go over what these candlesticks mean. All right, looking at the candlestick chart, first you'll see that we have red candlesticks and green candlesticks, and each individual candlestick represents a time period. And in this case, we're looking at a day because it says a day right here. And within that day, there's an opening price and a closing price. So let me pull up a candlestick right here. In this example, let's say that the opening price is right here and the price opened at this level, but during that day it rose and it closed at this price. Well, because the price moved up, the candlestick is colored green. Now a red candlestick is just the opposite. With a red candlestick, the opening price is at the top, but during that day the price dropped and the closing price was lower. So this would be a red candlestick. So a green candlestick represents upward price movement for that period, and a red candlestick represents downward price movement during that time period. You might also see two lines coming off the candlesticks, one at the top and one at the bottom, and these are the candlestick wicks, and this represents the highest price achieved during that period as well as the lowest price achieved during that period. So for instance, taking a look at this red candlestick right here, this is the highest the price went during that day, and then this is the lowest the price went during that day. Now that we know what a single candlestick means, we can now examine a candlestick chart, which is just a combination of candlesticks over time. Let's take a look at a live chart of Bitcoin. Now, the first thing I want to point out is that this chart represents one day. So each individual candlestick represents one day. So for instance, let's use this one right here. This candlestick is green, and this is the candlestick for July 21st, 2021. But I can change the time period from like 45 minutes. So each individual candlestick here represents a 45-minute time period, or 1 hour. So or 6 hours, or again 1 day, or I could even go to 1 month. So right here, each individual candlestick represents 1 month time period. Typically, if you are a day trader, you will look at the 15-minute or 1 hour chart, but long-term investors typically will look at a 1 day or weekly chart. I do grid bot trading, so I like to use the 6 hour candle chart for that. So now that you have a basic understanding of how to read a candlestick chart, let's talk about some basic chart analysis and what we can learn by studying these candlesticks. And let's start with two terms you might have heard of, and that is support and resistance. Support is a level which is typically found at the bottom of a downtrend. It's a range at which the price usually hits and bounces back up. Resistance, on the other hand, is a level which is at the top of an uptrend, and it is a range at which the price usually bounces back down. So for instance, if I take a look at this made up chart here, this uptrend is happening until it hits a point of resistance, and then it bounces back down, hits support, and then goes back up. Another thing to note is that once a price breaks through a level of resistance, that level typically becomes the new support level, and a new level of resistance is formed. So for instance, right here, this is on an uptrend. It breaks through this new resistance level, or this old resistance level, hits a new resistance level, and then bounces back down. And this level, which was resistance, is now support, and it hits it and goes back up. Now, traders can use this information to help them predict where a low point is to buy crypto and where the high point is to sell to make a profit. And let's take a look at a real world example to show you how this looks on a chart. I'm on the live chart of Bitcoin, and I'm on the live daily chart for Bitcoin. And I drew two lines to show you support and resistance. So this yellow line looks like a level of support, and this blue line looks like a level of resistance. And I say that because as this goes on a downtrend, it hits this level, this wick hits this level, and then bounces back up. Here, let me straighten this out a little bit more so it looks better. So right here, the price goes down, hits it, bounces back up, hits this level of resistance, and then bounces back down. It hits it again, goes back up, and then hits resistance, and then goes back down. Doesn't quite hit this support level, but it hits this level of resistance, and it keeps bouncing back and forth between these two levels of support and resistance until just recently it passed through this price of resistance, went past it, bounced back and past it a little bit, but then broke through. And hopefully now that this has surpassed this level, this will be the new level of support, and a new level of resistance will be formed. So that is how support and resistance looks on a live chart. And all I did was drew two horizontal lines so you can see those levels. Usually these won't be there, and you can just visually see this by looking at it. So if I were to scroll over here, you can see this looks like a level area of resistance, and right here was an area of support. Now let's build on the concept of support and resistance, and let's look at trend, or the direction the price is moving for a particular coin. When we look for trends, we are really looking for three different types of trends: an uptrend, a downtrend, and a consolidation. Let's look at the daily chart of Bitcoin again, and we'll be able to see all three: an uptrend, a downtrend, and a consolidation. First, an uptrend is pretty easy to see. Right here, if I just take my trend line and draw it from here, let's say to here, you can see that during this time period, Bitcoin was on a definite uptrend. Now, an uptrend is where a candlestick chart is consistently making new highs and then higher lows, followed by new highs and then higher lows. So for instance, let's take a look at this. So it started down here, made a new high, and then a higher low, and then a higher high, and then a higher low, and then a higher high. Now, a downtrend, let's move this over here, is just the opposite. On a downtrend is where the candlestick chart is consistently making lower highs and lower lows. So let's go here. So this is a definite downtrend. You can see that it's got a lower low and then a lower high, a lower low, a lower high, lower low, and then it went up here. So this is the start of actually our consolidation. A consolidation looks almost like a channel where the price isn't making any higher highs or higher lows, or lower lows or lower highs. The price is just staying within this range. And we saw this earlier when we were talking about support and resistance. So right here, if I take my horizontal line, draw this, draw another one below, you can see that it's bouncing back and forth. The price is bouncing back and forth within this channel until it's breaking out past this level of resistance. And this looks like it could, and hopefully is, a new uptrend. How do trend lines help us? Well, typically once a trend is started, it continues on until something happens to cause the crypto price to change its direction and start a new trend. So using our knowledge of support and resistance, we can use the trend line to see if we can predict a change in momentum. So for instance, we already talked about this right here. Because this broke the level of resistance, we are going to predict that Bitcoin is now going to be on a new uptrend. Now, just because it broke resistance doesn't mean that the trend will continue. We always want to look for confirmation that this trend is broken. So as of right now, it looks like it's on an uptrend, but we want to continue to monitor these candlesticks to make sure that this pattern continues. Another tool we can use to determine trend is a moving average. And a moving average line smooths out the price action to make it easier to spot trends. It is calculated by averaging several time periods closing prices. When talking about moving averages, the most popular is the exponential moving average. And the two most popular time frames are the 50-day as well as the 200-day. And you can see I have a 5-day here moving average in this blue. And the longer the time period, the more smooth the line is, and the shorter the time period, the more the line mimics the real price. So you can see the 5-day here pretty much follows the price, whereas the 200-day is a more smooth line. So I'm going to get rid of this since I don't use a 5-day moving average. And what this does, let's use the 50-day for an example. It takes the past 50 candles and averages it out to create this line. Same thing with the 200 days. It takes the last 200 candles and then creates this moving average. So if I move this to a 6-hour, I still have this moving average, but it's taking the past 200 candles that represented 6 hours, or the past 50 candles that represented 6 hours. So hopefully that makes sense. Let me go back to the day. Let me show you how we can use this. Now, what we can do is we can use these moving average lines as a potential line of support or line of resistance. So right here you can see in the Bitcoin, this 50-day moving average acted as a line of support for the price. So anytime it hit it, it bounced back up. Again, hit it, bounce back up, hit it, bounce back up. But once it crossed it, then that would be an indication to us that momentum may potentially shift and it could start a downtrend, in which case it did break above it, but then broke below it again, and then it was on its downtrend. Another way to use this is if the 50-day moving average is above the 200-day moving average, it typically represents a bull market or uptrend. However, if the longer moving average line is above, it's a sign of a downtrend. So right here you can see the 200 crossed the 50-day, and this is what's known as a death cross and typically represents a downtrend. But right here we look like we are about to experience a golden triangle, which is where the upper the 50-day crosses the 200-day, and then the 50-day, if we continue this on, would be above the 200-day, and that would be a sign of a potential bullish market. So this right here is an example of a death cross. Let me show you an example of a golden triangle. Here's a coin called sand, and right here you can see an example of a golden triangle. So right here, the 200-day crosses and goes above the 50-day. And when you see this, you would expect an uptrend or a bullish market. And in this case, you do see that it went from a lower price and started on an uptrend, and it's now making new highs. So this is how you can use the trend lines to predict trends as well as where you might want to enter a market. So far we've gone through candlesticks, support and resistance, trend lines, and moving averages. Now let's move on to some common chart patterns that you can use to predict price movements. And we will start with one of the best known and most reliable reversal patterns, and that is the head and shoulders pattern. All right, so let's take a look at this daily chart for a crypto coin called Sand, and you can see a clear head and shoulders pattern. And a head and shoulders is characterized by three prominent peaks. So you have the left shoulder here, and then you have the head, and then you have the right shoulder, and the right shoulder is not as high as the head or the left shoulder. This formation is one of the most reliable chart patterns you will see. And if you see this forming on a crypto asset you are monitoring, then you need to pay attention because it can signal a potential downturn. So for instance, on this one, you can see the left shoulder, the head, the right shoulder not as high as the head or the left shoulder, and then you can see a downtrend here. Another common pattern is the double top, and it typically signals a downtrend. You will see this chart pattern more often than any other chart pattern, and it is identified by two prominent peaks. So I'm on the algo 1-day chart, and you will see we have this first peak right here and then a downtrend to the 50-day moving average, which acts as a support line, and then it bounced back up and couldn't surpass this first peak, this first peak's high, and it started to trend back down, and it surpassed the 50-day moving average line of support. And you can see here we indeed did have a downtrend after the double top. There are other chart patterns, but those are probably the most common. Now that we've looked at some chart patterns, let's look at some important candlestick patterns that can give you a clue about where the price is potentially going to go. And there are numerous candlestick patterns that you can study, and I will leave a link in the description below of a great website that shows you all of the different patterns. But let's go over 4 easy to spot patterns that you can use starting right now. The first candlestick pattern we want to look at is the hammer. And when this candlestick pattern is found at the bottom of a downtrend at a support level, it can signal a reversal in price movement. Now, this formation of a hammer occurs when the crypto asset trades significantly lower than the opening price, but then rallies later on to close either above or close to the opening price. And in this case, this one closed above the opening price. And when you see this candlestick pattern form at the bottom of a downtrend, it can signal a potential uptrend. The opposite pattern is called a shooting star, and this is a bearish candlestick that forms at the top of an uptrend, and it can signal a reversal is coming and the crypto price is about to turn and move down. Now, this formation occurs when the price opens and trades higher right here, but then sellers take over and the price starts to drop, indicating a loss of upper price momentum. For each of these candlestick patterns, the color can switch, meaning this hammer can be red and this shooting star can be green, but it's the shape that is important. The next candlestick pattern we want to look at is called the bullish engulfing pattern, and this is a combination of 2 candlesticks. When this pattern forms after a downtrend, it can be a signal that the decline in price is going to reverse and this is going to start to go back up. Now, this candlestick pattern forms when a small red candle is followed by a large green candle that completely engulfs the previous candlestick. Now, the previous candlestick can be negative or positive, it doesn't matter, but what matters is this large positive candlestick. Again, if you see this candlestick pattern at the end of a downtrend, it can signal a potential uptrend. The opposite of the bullish engulfing pattern is the bearish engulfing pattern. It too is the combination of two candlesticks, and when this pattern forms at the top of an uptrend, it can signal that the price is going to start to fall. This candlestick pattern forms when a small green candlestick is followed by a large red candlestick that completely engulfs the previous candlestick. Again, the previous candlestick can be positive or negative, but what matters most is this large negative candlestick. What is important to keep in mind with any of these patterns is that you have to look for confirmation that a change in price is indeed happening and the trend will reverse before you make any trades. And let me show you some real world examples of how these and what I mean by confirmation. Let me show you an example of what a hammer candlestick looks like. And I'm on Alice, the 1-day chart. And you can see right here, we're on an uptrend, but if I fast forward, you can see we're gonna go on a downtrend. And then we have a hammer form right here. I know it's red, but this is the hammer shape. So what we want to do is look to see if the price starts to go up. And if I fast forward, you can see that the price did in fact exponentially go up big time. So that is an example of a hammer candlestick. And as you can see, it was on the bottom of a downtrend, it formed the hammer pattern, and then an uptrend followed. All right, let's take a look at a shooting star. So right here, we're on a downtrend, but then we're going to hit an uptrend until we reach this candlestick pattern right here, which looks like a shooting star. It's got a longer upper wick and a very, very short lower wick. So if I fast forward through here, you can see it does in fact lead to a downturn. So that is a shooting star, and that's how it looks in a chart. Now let me show you what a bullish engulfing candlestick looks like. So I'm on the 1-day chart, and we are in the middle of a downtrend. So it goes down and down and down until right here. You can see that this green candlestick completely engulfs this red candlestick. So we want to see if this indeed signals an uptrend. And if I fast forward, you can see that the price did start to go up. So that is how a bullish engulfing candlestick looks like. So let's look at a bearish engulfing candlestick. All right, I'm on the Algorand 1-day chart. And if you remember, a bearish engulfing candlestick pattern forms at the top of an uptrend. So if I start to fast forward this, you can see it's going up until right here. I have a bearish engulfing candlestick. I have this large red candlestick that is at the top and completely engulfs this green candlestick. If I fast forward, you can see the trend definitely was down after this candlestick. So that's how a bearish engulfing candlestick looks. Now let me show you an example of how you need to wait for confirmation before you can determine whether the candlestick was indeed signaling a reversal. So I'm on Constellation DAG. This is one that I track. So if I fast forward a little bit, you can see it was on a downtrend, then it started to go up. And then I saw right here, I saw what looked like a shooting star. And I thought the price was going to start to go down, but in fact, it went up. So that's what I mean by looking for confirmation. Once you see this pattern, you want to wait for candlesticks after to confirm that there is a reversal. So in this case, I saw a shooting star. I would expect it to go down, but indeed it did go up. And this is one last example. This is Veracity. This is a coin I follow, and this is real time. There is no replay here. This is live right now as of August 12th. This right here looks like the formation of a bearish engulfing candlestick. It's at the top of an uptrend. I see a large red candle completely engulfing the previous day's green candle. So I'm going to wait to confirm whether or not this starts to go on a downtrend. So again, this is what I mean by confirmation. This is one that I'm going to watch. Most cryptocurrency investment mistakes are either a result of buying the wrong crypto asset or buying the crypto coin at the wrong time. Now, I can't tell you what crypto asset to buy. You will have to research that yourself. But knowing how to read crypto charts and some basic technical analysis will go a long way in helping you become a better crypto investor. And if you'd like to learn how to take this knowledge and make money in the crypto markets, go watch that video right there, and I will show you how I use what I learned in this video to make a passive income with crypto investing. Thank you so much for watching, and I will see you in my next video.